Well, howdy there, folks. Welcome into today's video. It's a buy one, get two free in this one. 3 videos up here for me to react to. First one up here is this little 3-minute clip here. Tom Lee. Oh, yeah, Tom Lee had to make his CNBC appearance. So we're going to watch that, react to that one together. Then I want to actually get into this one. This matters, I think, for all PayPal investors, any fellow PayPal investors out there. Block CFO went on Cramer 2 days ago, and spoke with him about what's going on with their business. I think it matters significantly if you own PayPal stock. You always want to hear about Cash App, right? Cash App is a big competitor, obviously, to PayPal, to Venmo. So we want to hear what's going on with their business model. It's always very important you pay attention to your competitors and enemies as well, okay? And then last one up here is Jim Cramer is going to get us ready for the week. So I want to watch that, react to that, kind of give my opinions and perspectives on this week. This is the last week I'll be promoting my How Much Money You Need to Retire workshop. So if you want to access that, make sure you get it when this video is over here today. That will be pinned comments, absolutely free to enjoy that, okay? By the way, all I ask in return, smash a thumbs up. Make sure you subscribe to the channel. If you haven't done that yet, please do so. And shout out to all the people that as soon as they click on the video, they get the smashing done, okay? They smash the thumbs up. They always make sure they're subscribed. I appreciate y'all, okay? All right, guys, let's get into this.
Market panel, Tom Lee of Fundstrat and Jose Rasco of HSBC Global Private Banking and Wealth. Good afternoon to you both. I mean, it was a record week for the S&P, the Dow, and the NASDAQ, even though we slipped here in trading for the Dow and the S&P. Just the fact that we did reach new highs this week. Tom, I will start with you. How much of this is Fed? How much of this is ongoing AI enthusiasm? How much of this is economic data that continues to surprise to the upside?
It's all of the above, Morgan. It's always a good sign when not only is the S&P 500 making a new all-time high and, building on 4 consecutive months of gains, but it's coming when the other important indices like the NASDAQ and the Dow confirm those highs. I think we got a lot of good economic data recently. The economy is very resilient and corporate profits have been also surprising to the upside. But now we have monetary policy that is confirmed to be dovish, and at a time when there's $6 trillion of cash on the sidelines. So to me, these are all positive signals for stocks to make further gains. And I think sentiment continues to be overly cautious.
Okay. Jose, how do you see this?
So the big mistake everybody's making out there, I mean, this is a huge mistake, and I'm talking Wall Street, I'm talking hedge funds, I'm talking big-time investors, massive mistake they are making right now is assuming whatever the Fed is talking about is going to happen in the future. And we just know that's not reality. We know that's not reality, right? We know the Fed always gets it wrong. Always. And so I think anybody jumping to the conclusions and thinking, oh, the Fed's going to do this because they're saying they're going to do this a year from now, and the Fed says inflation's going to be here a year from now, and they say GDP is going to be this a year from now, and they say, 2 years from now, the unemployment, guys, no, it's not the way it works at all, okay? Not even remotely close. The Fed is wrong consistently and a lot, especially for any predictions that are long-term predictions. Anything a year from now, even 6 months from now, but a year from now, 2 years from now, they're wrong all the dang time in regards to that, right? Now, short term, maybe they can predict 1 month versus another month, but I'm talking about like a year from now, 2 years from now. So I think anybody drawing any conclusions about where the Fed funds rate is going to be 18 months from now, based upon what their data is or what they're saying, it's not accurate. I mean, 18 months from now, I wouldn't be surprised if the Fed funds rate was near 0. I also wouldn't be surprised if the Fed funds rate was, 7. So, it was we get another batch of inflation, let's say, in the economy. The Fed's going higher rather than lower. But that would have to be a big batch of inflation. We need oil prices to go flying. You need lumber to go flying. You need a lot of different things to happen, natural gas. But if that did happen for some reason, the Fed's going higher then, right? And then that would be very, very devastating this time around because we're not in as strong of a situation now as we were when we went into the first Fed rate hike cycle. At the same time, if the economy falls apart in the next 18 months, Fed's taking rates down to nothing. We know that.
We have seen market leadership broaden out as well. You've now got something like 80% of the S&P 500 constituents trading above 200-day moving averages. And we did get not one, but 2 strong IPO debuts in this market this week, too.
Yeah, we agree with a lot with what Tom said, but I think if you look, the cyclical side of the economy is probably going to slow because rates are high. And even if the Fed cuts, rates are still high. So the cyclical side, we should see some slowing. But you've got the four underlying secular themes that are going to continue to drive the economy upward. And we think multiples out and the market upward as well. So we're still bullish on U.S. equities. And remember 94, 95. At the beginning, it was a couple of stocks that led this whole thing on the tech side. And that broadened out. And we have not yet seen the power of the productivity gains we're going to see here from AI and a host of other technologies, right? And I think that has yet to happen. And that's going to help boost earnings as we go forward. And that's positive for markets. So yeah, we're bullish as well.
Okay, so Jose, when I hear you talk about cyclical parts of the market, maybe perhaps slowing here. I mean, we do have industrials trading at a record high, materials, some of these other more cyclical sectors. Does that mean that you take a step back as an investor right now and say maybe take some profits, maybe put your money to work in other parts of the broader market?
I think you're going to see that just from a valuation perspective, right? Growth has outperformed value dramatically this year, right? Year to date. And I think that's going to factor into people's decisions. You can dollar cost average your way into some pretty good stories in other sectors, but the growth perspective remains in place. And we think that's where you want to be. Remember, look at the Philly Fed from yesterday. The top line number was not great, but if you look at prices paid, came down a ton. New orders soared. And most importantly is the Philly Fed CapEx index. And that's something that for Tom's ideas and mine is crucial because it's telling you corporate America is still investing in long-term planning to build a more resilient economy. And they want to make sure they're on the front burner of that, not at the end of the train. So I think you're going to continue to see that. That's going to help lift valuations. But clearly, there's going to be some rotation of value here as growth has outperformed dramatically.
So to push back against that a little bit, okay, and then we'll get into this video, which is very important for all PayPal shareholders. To push back against that for a moment, right? Remember what I just told you, right, about the Federal Reserve and, 1 year out, 2 years out, they can completely change plans. Keep in mind, corporations can change plans as well, right? They can go from investing very heavily in their business to pulling back substantially. This happens all the time in corporate business. When you have any sort of big fluctuation, let's say in the economy, things go much better than expected, much worse than expected. All of a sudden, companies can go from, look at 2022 and then into 2023, a lot of companies were talking cautious. Then going into 24, a lot more optimistic, a lot more about investing in their businesses, right? And that's a change just in a year, right? And so these things can change very quickly. So don't just assume all companies are talking about, investing in their businesses so heavily for the next many years. That could change, okay? That could change, folks, okay? So just a little food for thought in regards to that. Let's get in this one. Once again, Block owns not only Square, which is, the card reader and the chip business and all those sorts of things, but they also own Cash App, which once again is a huge competitor to PayPal and Venmo.
As Block, the financial of Block. Take a look. Since I've seen you last, this has got to be the most exciting time I can recall for Block, a la Square. You focused on so many different things, but right now it's the one that all the younger people tell me about. It's Cash App, and it's about to explode.
Jim, thank you so much for having me here. We're incredibly excited about the opportunity we see with Cash App to bank our base. We have 56 million monthly actives. More important than that number is the engagement of those actives on our platform. 2 in 3 of them are weekly actives. 1 in 4 of them are daily actives. And they're using our financial services products regularly, like Cash App Card, which is a free Visa debit card that's customizable and is really popular with Gen Z and younger populations.
My kids had Cash App before. It was the first thing they had. And then I realized when I looked through your documents, there are 13-year-olds who are with it. And they'll be there for life.
Well, we have a families offering that is really unique because this is a population that's pretty underserved, and we get to grow with them. They're about 38% of our monthly actives, but only 28% of our inflows. So imagine the opportunity to grow as they become the spenders and earners of the future. And it gives us a chance to grow upmarket with them. We get to reach their parents and their aunts and uncles and their community around them.
I love the fact that as they get wealthier, you get more of their wallet, which is terrific. That's happening.
That's right. We see that as people use more and more of Cash App, they adopt more products. So not only 23 million on Cash App Card, but 3 million using our more nascent products. Cash App Borrow, which is a fast access line of credit. Cash App Pay, which is a chance to use your stored funds within Cash App at so many merchants around the world, or paycheck direct deposit. Now, when a customer is direct depositing into Cash App, they bring 6 to 7 times more inflows into Cash App, which is an immense monetization opportunity.
That's why you've got the great leverage that I've been looking for in the financial.
So as somebody that is a shareholder of a competitor, right? Because I'm clearly a shareholder of a competitor to this company, right? What am I looking for here? I'm looking to hear any strengths, weaknesses in their business, and specifically any big things that are trends that are going for them that maybe could benefit my companies, such as she mentions direct deposit there, 6 to 7 times, the amount that somebody would have there if they are doing direct deposit. And I think about that opportunity for PayPal and Venmo over time, right? And so that's just kind of the way I think about it in regards to thinking about a competitor. What am I listening for? I also want to hear if there's any weakness in the business, because if there's weakness in that business, there could potentially be weakness in my business, right?
You are doing a lot of exciting things, and you're doing them with a thin group of people in terms of encouraging productivity. A cap of 12,000, something that Jack Dorsey talks about as being a great way to recenter the company.
That's right, Jim. This is a way for us to use constraints to drive creativity. So constraints here are the number of people we have at the company, and it drives a focus on what matters the most. It helps us prioritize our work, and it helps us think strategically about what most benefits our customers. Of course, it all...
Guess what? I'm also thinking about PayPal right now. I'm thinking about, man, I like this idea of capping the amount of workforce, and I love just focusing down on the biggest opportunities, what matters most. That definitely sounds like some Alex Christ type stuff and where he's trying to take PayPal over this next year.
Benefits the bottom line. And that's where we see significant margin expansion opportunity. What we've guided to this year is already 8 points or more of margin expansion. And we want to do more of that as we hit Rule of 40 in 2026.
Right, and that's a great growth and margin story. And I think that people should recognize that a lot of financial services companies would kill for that level of growth. They don't have it. Some other things that you do are just, I think, cutting edge. You do fractional shares. Is it working?
That's right. So within Cash App, you have the opportunity to buy $1 or $10 of NVIDIA or Berkshire Hathaway. It's a really exciting opportunity to bring people in to stock investing. When we launched this product in 2019, what we saw was over half of U.S. households were not investing in the stock market. So this is an opportunity to make it more accessible and bring people into the significant wealth creation opportunities that others already have.
Okay, now we are big fans of Bitcoin.
Do I like that idea there? The idea of essentially, buying a fraction of a stock, right? And the answer is absolutely. I love that idea. I think, it's something I wish was around back when I first got started in the market. I mean, when I first got started in the market, guys, it was rough. Listen, do you know how much it was every time I went to go buy a stock or sell a stock? Do you know how much I had to pay in commission? I know a lot of you guys that are young and you don't even know about commissions. You're like, what? It's free to buy a stock. You just put in your $300 and you buy $300 worth of stock. Listen, when I got started, it wasn't like that. I had to pay, listen to this, $19.95 every time I bought a stock. It didn't matter if I bought 1 share of a stock or 1,000 shares of a stock. $19.95, and then another $19.95 when I went to sell that stock, which is brutal when you're investing under $1,000 at a time. I mean, absolutely brutal. I had to get such a good gain on a stock just to break even from my trading commission. It was rough, man. It was rough. So yeah, all you guys that got started and you never paid a commission in your life, whew, you got it good. That's all I'll say.
Not against it. We think it's a great stronghold of value. Do you think it can go back to where people thought that at one point it would be used as a currency?
So we want to drive utility to Bitcoin, and we've got multiple ways to do that. We do, with our Lightning Network initiative, C = have an opportunity to use Bitcoin as a currency, but we're looking at the multitude of ways: a store of value, self-custodying, buying and selling Bitcoin, mining Bitcoin, and global remittances. Those are our efforts. They're relatively small today and experimental, but we see a significant opportunity to drive utility and, again, bring more people into the economy.
If someone wants to open an account and buy Ethereum, are you a place that you can do it?
No, we only do Bitcoin.
Really?
Yes.
Is it time to expand to others?
We think Bitcoin is the longest lived, best brand, open developer ecosystem. and we see a significant opportunity behind Bitcoin.
Fair enough. I want you to be more expansive because it's hard to find places that you trust that can allow you to buy the others, but maybe that's because you vetted them and not sure they're necessarily the right ones to be in.
Trust is critical. And again, focus for us is critical. And that's where the focus is with Bitcoin.
Okay, you spent $29 billion on Afterpay. How's it working?
Afterpay is an incredible opportunity to bring commerce into Cash App. We had over 20 million consumers on an annual basis using Afterpay with increasing frequency. These younger customers, Jim, don't trust the negative debt spirals that you see from credit cards. And so with Afterpay, we grew our gross merchandising volume by 25% in the important seasonal Q4 quarter. And I think there's even more opportunity to integrate it into Cash App and to bring those local commerce opportunities out between the combination of Square, Cash App, and Afterpay. That's where we really think that Block is differentiated.
Great, I'm glad.
That was my personal opinion on that. They messed up that deal. They way overpaid. My personal opinion.
The term Square, because you work closely, obviously, with Jack Dorsey, who's running Square. Can you just give us the kind of the division of labor? Were you in, for instance, on the decision to cap at 12,000?
Absolutely. This was a joint decision across our leadership, but driven by Jack in an effort that was really brought out by clarifying our our financial targets, which is to reach Rule of 40 in 2026. What we've said is we believe we'll get there by a 15% growth rate, hopefully more, or a 25% or so adjusted operating income margin. Well, to drive that kind of margin expansion, we need constraint. And to drive continued growth at scale, we need focus.
Well, that's one of the reasons when you say Rule of 40, I mean, I was always questioning how much you're balancing profitability and growth. I'm not sure right now. You can clarify right now for us. Equal, more growth? Because I love the growth app, but yet when the pivot occurred after the Fed changed, I want more profitability. I want profitable growth.
We want profitable growth, too. And because we invest in high unit economic businesses, when we drive a point of growth at the top line, that drives high incremental margins at the bottom line. So growth is ultimately accretive to both profitability and the top line.
One last thing I got to ask you is I didn't ask on people out here. You do a lot of work from home, but what's your feeling about San Francisco right now as a place to work, as a place that people are starting businesses? Is it safer? Are more people coming back here?
I mean, there's incredible talent here, Jim, and I think that there's a real buzz in the air. That said, we want to be a global company, and we want to access talent all around the world. This is why we allow our employees to work in a distributed manner, and we can find diverse talent, excellent talent in many other cities around the world, too.
Well, I've been recommending your stock for some time, and I hope people understand now why. Because
smart answer there by her. She didn't dive too much into that. She quickly said there's, talented people in San Francisco, and then just kind of like, oh, we want to be a global company. Before we get into this game plan for this week and react to that, do I like Square stock? I don't think it's a bad stock. I don't think it's a bad stock. With that being said, I like PayPal's risk reward a lot better than Square. And why do I like PayPal versus Square? First off, start at the forward P. It's dramatically lower for PayPal versus Square, right? PayPal, I'm getting several established brands. I'm getting kind of like a 3-pillar approach where I'm getting PayPal, right? I'm getting Venmo, which are two dominant apps out there, or websites, whatever you want to call them, but apps. And then you're getting Braintree as well, right? Which is a back-end payment running for a ton of companies. And so, especially a lot of bigger companies. And so I just like the diversity overall I get in a PayPal and the valuation I get versus a Square. And so, Square I worry about a little bit more, like if Cash App's brand has ever heard of something happens there, how detrimental that could be for actual, Square's business model there, right? Or Block as they call themselves now. Okay. Alrighty, let's get in this game plan for this week.
Come to an end. So today we bid adieu to the West Coast, where we learned about all things AI from NVIDIA, championed Apple's Vision Pro as a business-to-business product tied to NVIDIA's platform, and reiterated that you should own, not trade, both stocks, even as Apple's now under assault from the Justice Department for unfairly putting out a real good phone. Oh, just another week in the life of Silicon Valley, which we shared in the bounty of still one more week of record-breaking action. Even as the market lost steam today, Dow slipping 305 points. S&P declining 0.14%. NASDAQ actually advancing just 1.6%. I'll take it. So what awaits us when we come in next week? As early as Monday, a familiar symbol returns to trading, DJT for Donald J. Trump, which is the SPAC that converted Friday into Trump Media and Technology Group. I'm mentioning this vehicle because it could produce a big windfall for former President Trump, whose stake in the company is worth about $3 billion now, and could be worth much more if the stock stays above certain levels for just a few weeks. His stock's going to be locked up for 6 months, but he could petition the company's board to begin selling his shares immediately. Worth noting because his company and his campaign apparently need money. Rarely do you get a SPAC like this with such political implications. We also get new home sales on Monday, and we know that housing is at the heart of the Federal Reserve's dilemma. See, the Fed needs more homes to be built, okay? He's got to bring down the cost of rent, but the home builders have been reluctant to increase construction because of higher mortgage rates. If Jay Powell wants more homes to be built, he should actually be cutting short rates. But if he does that, well, the price of housing will skyrocket. It's not even a Hobson's choice, for heaven's sake. Yesterday, the Justice Department came after Apple with everything it had, which was, candidly, not much. But Apple had a weak stock for ages, and the suit just brought out more sellers.
So that's no. Okay, no. That thought process is so flawed. And Kramer's not the only one. I've heard so many people say this. Thought process so flawed. If Powell cuts rates, housing prices are going to skyrocket. If he cuts rates, listen, okay? Everybody and their grandma thought housing prices were going to plummet when they started to raise rates, and they raised them considerably, right? And, oh man, it's going to be another great financial crisis type housing situation, blah, blah, blah. That never happened. It just never happened, right? And what we've seen with high rates is people can't move. So supply is tight in a ton of markets out there, right? And so to, let's call it, get the market moving, right, which could actually end up bringing down prices, because think about it, if there's a lot more homes available out there, well, suddenly, maybe there's a lot more competition. And then this house sells because they dropped their price low, and then everybody else sees that and they're like, crap, man, we got to bring down our prices as well. If there's hardly any supply out there, there's always going to be some buyers. And so if anything, that keeps prices potentially even artificially higher for longer, right? So that's just it could be right. Let's say Powell cuts, the housing price skyrocket. It could be right. But to just assume, oh, for sure, that's slam dunk, yeah, I don't know if that's the way it's going to work. Because I've seen everybody just be wrong and wrong and wrong and wrong and wrong again and again and again in regards to trying to predict these housing prices and what was going to matter and what was not going to matter.
Hear from Apple and Google about an artificial intelligence tie-in, and maybe more about the Vision Pro for the enterprise, like what we saw when NVIDIA live streamed their Omniverse to the device, and we almost...
By the way, if you ask me, do I think this potential Apple Google deal is real in regards to AI? I think it's a pretty decent probability that it's real. And the reason being is both stocks need it right now. Google's stock's been in a really tough place. They need some credibility. And if they're partnering with Apple, it would give them credibility essentially in what they're doing with AI. And Apple needs something AI related. They're getting no love and respect from the AI side, right? And so this would at least people would kind of oh, okay, they kind of figure it out with Google.
Car that didn't even exist? Yeah, the resolution was that great. The Reddit IPO came earlier this week, and it was a success as the company managed to place enough stock with loyal Redditors, who for the most part didn't sell. The company isn't making money yet, but it's on track to get there eventually, although the stock started pulling back today. I'm less interested in this company, frankly. I'm more interested in whether the Redditors will return in force to focus on individual stocks again, like they once did with GameStop, which reports on Tuesday. I expect another dismal quarter, of course, but that never stopped anyone from the Wall Street Bets department of Reddit. I don't expect a repeat of the action from 3 years ago, but perhaps they'll help prop up the stock after another horrendous set of numbers. Also on Tuesday, I think we could be in for some better than expected numbers from McCormick, the big maker of spices and seasonings. Oh man, their last quarter, I'm calling it subpar. But I bet this terrific house of flavor brands, without a lot of fattening product, by the way, could have upside. The last two food companies that reported, Hormel and General Mills, both had nice upside surprises. Let's see if three's the charm. Wednesday, we hear from the most consistent company of the week, which is Cintas. That's the uniform rental company we have on that's also expanded to providing all sorts of essential fire and safety services to small, medium-sized, and yes, large businesses. Cintas has just repeatedly blown away the numbers. I expect nothing less this time. Bankable. And then there's a wild card, Carnival, the cruise line. Royal Caribbean has pulled away from the pack here. Can Carnival catch up? I think it'd be hard not to. Hey, next, Kimberly Clark. Yeah, storied name. She's got an analyst meeting on Wednesday with a great brand.
Yeah, Carnival's a good play for the next, 5-10 years, even if there's a big recession in the next 5-10 years. And the reason being is there's just so many baby boomers that are hitting retirement age, that have already retired or about to retire, and they're going to go on a lot of cruises over this next 10 to 20 years, I can tell you that much.
Plus 4% yield. This company may be ready to play offense after some slowdown caused by the persistence of this work-from-home ethos. Remember, Kimberly Clark does a lot of enterprise business, keeping the office bathroom stocked with soap and paper. I think the stock's pretty interesting down here. Thursday, Walgreens boosts the line. Speak of interesting, down here, reports. And for once, I'm actually excited about this drugstore stock because there could be a turn in hand now that they brought in Tim Wentworth. At last, a seasoned healthcare exec as CEO. It may be too soon to make big changes, but something has to be done pronto. I just love to hear Wentworth lay out a plan for Walgreens to return to growth. He clearly has one, or else he would never have taken the job. It's not like he needs to work. It's not like he has to prove anything. He used to be the CEO of Express Scripts, one of the most successful pharmacy benefit managers ever, which he sold to Cigna for a cool $67 billion. We just got
Walgreens has been an insanely disappointing, just disappointing stock, just to be quite frank. I mean, it's one of those companies you look at it and it's trading at like a 5 or a 6 forward P, and you're like, how is it trading at this? And it's just it never goes up. It's ridiculous.
The torture of a Fed meeting. So I'd like to keep the Fed speak to a minimum, please. But I do want to point out that on Friday we get the personal consumption expenditures numbers, and this apparently is Jay Powell's favorite inflation reading. The bottom line, we're no longer fighting the Fed, people. They don't seem inclined to raise rates when they're supposed to be cutting them. That doesn't make sense. And that means even if we hear a lot of noise about an overheated inflation number, I'd, yes, consider...
No, that's baloney. That's baloney, folks. Okay, listen. We are still fighting the Fed. Whenever the federal funds rate is substantially above whatever inflation's running at, you're fighting the Fed. That's the bottom line in regards to that, okay? Right now, we got a Fed funds rate, 5.5 or so? And we've got inflation running, 3.2, let's say, for instance, right? It depends upon if you want to use government data. If you want to use true inflation, you're in the 2s. If you want to use government data, 3.2. So there's a big gap in between, obviously, where Fed funds rate is at versus obviously where CPI is at. So we are still fighting the Fed, and I just want everybody to always understand that, okay? All right, appreciate everybody joining me as always. Thanks so much for being here, folks. Once again, this is my last week promoting my workshop on how much money you need to retire. So if you want access to that, get that right now. That will be the pinned comment down there. It's absolutely free for access to that. Much love and have a great day.